Ladies and gentlemen, please take your seats. The show's about to begin. Omar, let's put on a show. Today, I am joined by Omar, who is the co-founder and CEO of Keyper. Now, if you'll have been paying attention, and if you'll have watched the season 3 finale, you'll know that actually he's my ex-co-founder.
That's right.
So I co-founded Keyper with Omar back in 2021. And I'm no longer there, but yeah, full disclosure. And what I thought would be great today is we've got 3 things to talk about. One is you've just raised a substantial figure, $34 million, not dirhams. So we're going to talk about that. And I want you to also tell us a bit more about the latest Rent Now, Pay Later product that Keyper has just launched. And also, you're quite the angel investor / entrepreneurial startup founder, incubator advisory person with some really useful insights for any aspiring entrepreneurs out there. And we want you to kind of educate us a little bit on that section. So first, I want you to kind of introduce yourself. Now, we did so many pitches together, fundraising, that I could probably do your background word for word.
Let's do it.
It starts with, so I started my career on Wall Street, and I'll let you take over.
Yeah, sure. So I started my career on Wall Street. Worked for 5 years at Citigroup in New York. And in 2008, when things were very shaky in the US, that's when I made my move to Dubai. Worked 5 years with Credit Suisse, also on the investment banking side. We did mergers, acquisitions, bonds, securitizations, you name it.
You're a finance bro.
Yes. And then moved to Goldman Sachs for another 5 years, and then moved to Guggenheim Partners as head of investment banking for a couple of years, and that was during COVID. Mm-hmm. And during the COVID times, I decided, I've had enough through my investment banking career, 18 years, and I wanted to work on my next chapter. And that's when I started thinking where I want to be, and fintech made a lot of sense for me, coming from the finance background, meeting tech. But when we looked at the TAM and the addressable market and where I'd like to be, that's when I started gearing it towards real estate. Mm-hmm.
And we're going to tell you what TAM means later on, because we're going to go through a glossary of tech bro terms. But yeah, okay, so you decided next chapter.
So next chapter.
Fintech probably, but then it turned into prop tech.
Yeah,
so how did that happen?
It's the intersection of prop tech and fintech. And really in any tech company, there's always could be an element for fintech as well. And that can really help boost the company. And that's the path Keyper is on today.
Okay, so you yourself were an investor, a real estate investor. You suffered with a few pains. Can you just tell us about some of those and how they inspired Keyper?
Yeah, sure. I mean, as investors come in here, I'm as a finance investor and I want to buy stocks, I have all the information I need. I have research reports. I have the live valuations. I can read and understand the stock and understand what they do and predict where it's going. In real estate, that's a bit tougher. There is no real, valuations, live valuations. So we decided to create the first live valuations in the market.
You didn't
There's
have much.
very limited research reports out there. There's limited data that we know investors in general would love to get that data or have access to them when they're making their investment decisions, versus relying on the agent community to guide their investment thoughts.
So you didn't have much visibility on your own property portfolio, but you do on your other investments. So it's like, what, this is probably where most people's money is tied up in real estate.
Correct.
But it's shocking that they don't have that kind of visibility.
So as an ex-banker, kind of a bit learning from the private banking model, private bankers come and advise families, on their stock portfolios, on commodities, on their fixed income, on their equities. But they stop when it comes to real estate, because that's usually an asset class that private bankers don't touch, or they just kind of gear them towards investing in real estate funds, but that's where it stops. But the reality is, in our region, the majority of the wealth is tied into real estate, and investors are becoming more and more sophisticated, and they're asking to get more and more visibility and have that live visibility to make the best decisions.
Informed decisions.
Correct.
Okay. So that explains how Keyper was born. You, obviously, as a tech startup founder, it's fair to say that raising capital is, you could have an amazing idea, you could have an amazing team, but without raising funds, you're going nowhere. So that was a big focus for you, and you're very well connected, so it made life a bit easier, but it was still a challenge. So can you just tell us about your recent raise?
Yeah.
The headline raise.
So our recent raise was $34 million, of which $4 million was equity and $30 million was in debt form. The $4 million was led by Beko, MEVP. We today have 4 VCs on our cap table. And you always want to look for not just the money, you need to find the investors that are going to back you and help you grow your business and help you with the strategic direction. So we're very, very fortunate to have a really strong cap table on our, of investors. On the debt side, we did a Sharia compliant financing, which is a sukuk financing, one of the very, very few Sharia compliant sukuks that were issued by a startup. It was a $30 million with Franklin Templeton. Franklin Templeton is one of the largest asset managers in the US and globally. So we're very, very fortunate, and we're very happy about the partnership.
And that is going to help finance all this rent you're paying now.
Correct.
Later.
That's a very, very important point. The financing that we have, that we put in place, is not to fund the startup, it's not to fund Keyper, but basically to help finance the rent now, pay later product and the upfront rent product. So it's really 100% of that proceed will go to landlords, and the tenants on the other side will be paying that on a monthly basis.
So in terms of kind of startup funding, $4 million went towards the business, tech costs, salary costs, growth, marketing, and all of that. On top of the $6 million already raised in your pre-series,
correct,
in your seed.
Pre-seed. Yes, that's right. So the $4 million is just the latest tranche. We have raised to date, since inception, about $6 million. So total equity raised to date is closer to $10 million.
Okay, let's talk about rent now, pay later. You love this.
Sure.
What was the problem? Because I ask this to every prop tech. What is the problem you're solving for? Yeah,
I mean, that was core of what we're doing, is we were trying to solve big problems for the landlords, but there was such a big problem on the tenant side that we felt the need to help address. And this is unlike, other Western markets like the US and Europe, where people pay their rents on a monthly basis.
Right.
Here you come to Dubai or Saudi, and the landlords are demanding 1 check, 2 checks, going up to 4 checks. But you unfortunately still get paid from your employer on a monthly basis. Right. So there's that gap of expectation and demand, and people just have to cope with it. And companies used to finance that, and more we're seeing, more and more companies being reluctant to give that financing for their employees. So we're there to solve a problem for the tenants, to help them with their cash flow management. And the way it worked, it's called rent now, pay later, kind of similar to buy now, pay later, and we kind of we're the first to use that phrase, and it allows the tenants to pay on a monthly basis.
In line with their salary.
In line with their salaries, right, and their capabilities. And on the landlord side, if they do wish to keep it as 1 check, 2 checks, or 4 checks, we have flexibility. So the option to the landlords is either to keep as is, or we're happy to give them the entire yearly rent in 1 check, in 1 go, and willing to take the default risk of their tenants. Because what we do is we help these landlords vet the tenants, and we do the credit checks on their behalf.
Yeah, because that's what happens in the US and the UK. Yes, it's different. You can pay your rent monthly in Europe, but they do such stringent checks on first of all, they check your credit history, your employment. They will also call your previous landlord to find out if you paid your rent on time, if you left the property in a good condition, and they may get a personal reference as well. So you've got to jump through quite a lot of hoops in order for a landlord to accept you to pay monthly. Here, because of, the time I moved to Dubai in 2017, and the impression I got moving here at the time was that rent needed to be paid a year in advance. That was the kind of word on the streets.
Yeah.
But then when I moved here, I found out actually it's quite common to pay in 4 checks, which is the most popular.
So it actually was the most popular, I think, even a couple of years ago, and during COVID times, the landlords were more lenient. But we've seen now in the last 2 years, it actually moving more towards the 1 check and the 2 check.
But that's because of the market. The landlords have been in a powerful position where they can negotiate on the rent. Yeah, they can demand the rental that they want, because and I'm not gonna say like point the finger at landlords, because they took the pain during COVID. They accepted 13 months rent, or 1 month free, 12-month tenancy. They took the lower rates without complaining. They gave it, some of them, so they're ready to ride the storm. So I don't blame them for riding the highs of that wave. So the highs of that wave is, yes, you might end up in a bidding war. You may get over asking price on your rental property, but you're also in a position where you can demand 1 check payment or 2 checks. What are you finding most common?
And the reason the landlords are demanding the 1 checks is because they don't want to deal with the defaults and all of that. So if someone kind of also solves that problem for them, they're happy to enable that solution and allow their tenants to pay in 12 installments. And the other thing that I want to mention is these tenants of ours are not paying us by checks. We want to digitize that process. We want to get rid of the old checks. The only time you're using checks is to pay your rents. You don't use it any other time.
And how awful is the check? Like when I write a check, which is very rarely only for rent, when I'm writing that check, it is like my life depends on it, not to make a mistake and to sign my signature as accurately as possible and not to misspell the words or anything, or even the name. So it's such a daunting process. But when I'm doing it, I'm like, why is this still happening? Why am I writing checks?
And in a lot of markets, it's not. And the central bank and RERA wants to encourage digital payments. And we have all the means in the world. So what we've done is we've adopted direct debits that allows you to take money directly from your bank account, or payments on your debit cards or on your credit cards. And in the credit cards, you can also use and utilize all the rewards from paying your rent.
So get Skywards, for example.
Get a flight back home with the 100,000 dirham of rent that you just paid.
Yep, good point. Okay. But why do landlords still want that check payment? Is because there is that association with, I'm not getting this tenant vetted, and whilst it's no longer you don't go to jail anymore for bouncing a check, it's still that comfort of knowing I've got a check in hand. If it bounces, I can then escalate.
It's a bit of a false fact. You can actually evict even if someone does not give a check, because at the end the tenant needs to prove that they made the payment for that rent. So
it's also, do you feel a responsibility to kind of educate the
landlords? Yeah, absolutely. We are working on educating the landlords. We're helping them understand that it's way more convenient to do payments digitally. For example, to give you one example, if one of your payments is for 10,000 dirhams and there is in the bank 9,000 dirhams, the check bounces and you get 0. But if you try for a digital payment on your credit cards and the 10,000 dirhams fails, you can try again at 9,000 dirhams and you at least recover 90% of that payment.
So it will just take whatever's in the account.
Correct. Right. Into whatever is in the credit card limit.
Okay, so let's kind of simplify it as much as possible. I'm sure everyone's familiar with buy now, pay later. Anybody that's familiar with online shopping will see a Tabby or I don't know the other Tamara tab. Yes. Just at the checkout saying, split this into 4 payments. Or even after you've paid for something on your credit card, your bank will send you a text saying, split this into 4 easy payments or monthly payments, right? So in that scenario, it's interest-free, effectively. I can just agree to it, and it spreads the payment. When it comes to rent, let's just take, for example, let's assume I'm about to sign a lease. It's 100,000 dirhams, for argument's sake. And my landlord wants 100,000 in one check. That's what we're negotiating. Just to backtrack, what stage do you want to come in at? The negotiation stage or after the deal has been done?
Yeah, I mean, we typically come either before. A lot of the people that are applying today for rent now, pay later, they apply, they get their credit approved, and then we help them find the units that they can rent, and they pay monthly, and landlords that have accepted those payments.
So just to give some background on that, because you've been a landlord investor app, you already have a bank of how many onboarded properties?
3,300.
Okay, so you already have access to 3,300 units that are down to accept rent now, pay later.
Yeah.
Plus you have a network of agents that you're partnered with.
Correct.
So you already know who's ready to accept this. But let's say I'm a tenant. Do I approach you as I start looking, before I start looking, or at what stage?
I mean, we're flexible. Typically, yes, you would reach out to us as you're looking. You'll get your credit approval. You'll know how much we can finance you up to, right? And then we'll help you find this unit. But we don't need to find that unit for you. You can find that unit with any other agents or on Property Finder yourself, and then we work with you and the landlord to put things in place. So, for example, if it was 100,000 dirhams in 4 checks, we would offer you to pay 106,000 dirhams, and the new lease will become at 106,000 in 12 installments.
Okay,
and that's what we will have on the landlord, the tenant side. On the landlord side, we either tell them, look, you have 2 options. We can pay you the 4 checks, the 100,000 dirhams in 4 checks. Or if you want, we can pay you all that money up front, call it 92,000 dirhams.
Okay.
And if we do that, we will give you property management services. So, and we will do the ijari. We will also take the credit risk on your behalf.
Okay.
So
That's
if your tenant
important.
defaults the 2nd month or 3rd month, you've already gotten paid. What we do for you is we would go through the process of eviction and finding another tenant, vetting them, and another tenant at the same or higher rents.
Okay.
And we guarantee that for you.
So let's take the tenant side. So I'm a tenant. I think I have a budget of about 100,000. I could do it in 4 checks. I'd rather not because I get paid monthly. And one word of advice is if you go to a landlord and say or place an offer saying you want to pay in 6 checks or 12 checks, that's red flag central. It sounds like you're a delinquent tenant, right? But if you do it through Keyper, they still feel like, well, it doesn't matter. You're getting I have an arrangement with Keyper to pay them monthly. You still get your 1 check payment, 2 check payment, and that's something else that you do. It doesn't have to just be the 4 checks. It can be 4 down to 1 check, 4 down to 2 checks.
Correct. We have flexibility with the landlords on how they would like to be paid. A lot of times, landlords typically have several units, and sometimes they see another unit that they want to buy, so they can use the service to kind of like cash out upfront their several units, get that payment in place, and buy a new unit with it.
So if I were to describe Keyper, then it's kind of like a mini mortgage for tenants.
So it's not a mortgage, but yes, we provide financing solutions.
Yeah, it's financing solutions
to landlords to enable them to better manage their portfolio and get more out of them.
The same as you have releasing equity. You go to a bank to release equity from a mortgage to buy another property. You could do the same with releasing equity from your rents. Effectively.
Correct.
You're getting an advance on your rents.
Correct.
So, and it's not just at the beginning stage, right? So you could, let's say I'm a landlord, I'm halfway through the tenancy, I've got 2 more checks to collect, but I really want that Hermes handbag now, for example. I could contact you and say, give me the remaining 2 checks up front.
Correct.
Now.
So we have, I invite everyone to download the app for landlords, and we're soon going to have also an app for the tenants as well.
And
but
actually, I'll put a link up here somewhere, because if you want to know more about the solutions for landlords and tenants and the application, me and Waleed went on for about 1 hour and 20 an episode. I don't know what episode was that. In season 2, Waleed came on. So I'll put the link to that up there if you want to know more about that side of the business.
But on the app, basically, it gives you an offer on a daily basis. So any day you want, mid-tenancy, you feel like you want to take that rent up front today, we have that flexibility to help you do that.
Okay.
And the app is free, just to be clear with everyone.
And for free, what do I get? I get the valuation.
So you get the live valuation, you get news about the market, you have a library of documents, you have an income statements, you get notifications. The notifications will show you all the cash that you're going to be coming in or when you need to give your tenants notices. And also now we have, you get notifications for if someone else in your building is selling a property or leasing a property. So you immediately have the best knowledge of what the value is, and you understand how we're coming up with this live valuation.
Right, similar to other asset classes.
And you have research reports as well, that from other third-party sources and from Keyper.
Okay, so it's kind of like an app that you would have to manage your crypto investments or your any other asset class.
Yeah, but with crypto, people don't have the backing of why things are going up and down. With real estate, actually, there's a lot of fundamentals and research and news out there that can really help you better understand the market.
Okay, so going back to rent now, pay later, the tenant can split their rent into 12 payments, and the key point to make is that you now accept the default risk. Can you tell us about that? Yeah,
I mean, look, typically landlords, and that's the reason they're asking for one check, is because they want to reduce the risk of non-payments from the tenants. So we help them do that. It's kind of like getting insurance. And even better than insurance, we're not paying you when your tenant defaults, we're actually giving you the money up front.
Yeah.
So you don't have to worry about us not paying you or, like insurance companies may find ways not to, but for us, it's very simple. The money, we give it to you right away, up front. And we take that risk on. It's on us to recover our money back by releasing the property and by doing the evictions.
Similar in the UK, when you go through the referencing process, or I'm sure it's the same in the US, you go through the referencing process, the company will tend to add on a service or an offer for rent guarantee or insurance to the landlord. So we've vetted this tenant enough to say we'll even guarantee that they're going to pay their rent. So that's another product that's out there in the UK. So in a way, Keyper is sort of offering insurance.
We are offering that.
You are, because if that, let's say that tenant doesn't make that monthly payment in month 2 or 3 or 4, you're not
the
going to...
The landlord has already been paid.
Yeah, you're not coming to the landlord to say, pay me back.
Correct.
Okay, so then it becomes your responsibility to evict the tenant, try and recover the losses, and that's why you need the property management control as well.
Correct.
Okay, completely makes sense. Anything else to add on rent now, pay later?
I think it's
clear.
Nicely.
Okay, well, if you have any questions, how do we find you? Or your team?
Look, I mean, we have websites, realkeyper.com and rnpl.ae. Please put those as well.
Yeah, we'll put them down below. And how to get on the wait list?
You can apply online. and we'll get back to you within 24 hours.
Okay. And if I'm an agent, because my audience is predominantly real estate professionals, how does this help them close more deals?
So a lot of times there's a gap in the market where an agent finds a tenant that wants to lease a property, and the tenant loves the property and they want to do it, but they just can't do the one check. And they can do 4 checks or 3 checks, and the landlords insist that they only want one check, and that deal just falls apart. And we can provide that solution where we can give the landlord that one check, and even allow the tenant not only to pay in 4 checks, but even to pay it in 12 installments on their credit cards, and for them to get the reward program. So we've been very, very fortunate. We've already exceeded 10,000 applications from tenants with demand over $60 million. So it is working, and we're working with a lot of agencies now. A lot of agencies don't have property management, so we help them with that. We even pay referral fees for property management, and we help them close deals on rent now, pay later.
Okay.
So we have about 26 partnerships with agencies, and we want to build more of those partnerships.
So if you're an agency that doesn't do property management, you can partner up, you can collaborate, and there'll be some kind of affiliate commission involved. If you're a leasing agent and you're struggling to close a deal because of the number of checks, reach out to you. Should they reach out to you as agents, or should they?
No, the agents can reach out, the tenant can reach out. We're flexible. And just to be clear, we're not sharing any of their commission. So they get to keep their full rental commission on the transaction.
Fine. You will just help facilitate it.
Correct.
And how quickly? Because, Dubai is moving quick.
We can move within, 1 to 2 days.
So, as you know, Omar, rents in Dubai can range from 30,000 all the way up to $1 million.
And they've gone up significantly in the last 2 years.
So is there some kind of you
a
can lend
spot?
a sweet spot for you, or what's the highest that you're ready to finance?
Yeah. I mean, look, as we're building the book, we can go up exponentially. For now, we're starting with a minimum of 30,000 dirhams and a maximum of about up to 400,000 dirhams.
Right.
So most people will fit into that bucket.
Okay.
If your rent is over 400,000
you probably
dirhams,
don't need it,
and you still need financing,
that's a problem. Or you might just be thinking,
we have applications for up to 1 million dirhams of people applying for rent.
Yeah.
It's difficult for us to serve those people at that time because it creates concentration risk in our book.
Yeah.
But in the future, inshallah, we'll be able to help them as well.
All right, good. Okay, so that's where the 30 million is going. And it's not just a case of that you could finance, let's say, I don't know. I mean, that's $30 million, not 30 million dirhams.
Correct.
But it doesn't mean once you've financed $30 million worth of rents, you stop for a year, right?
Correct. I mean, we're doing them in tranches. So we have a first tranche, second tranche, and third tranche. And as we have more and more demand, we're able to get more and more financings. Okay,
so call to action. Tenants contact you when they start their search, get pre-approved and all of that, or as they're just about to close a rental contract.
Correct.
Landlords, download the app, or property owners, download the app. How else reach out for property management services?
Correct.
If they want...
They have a relationship manager assigned to them on the app as well. They can reach out to them for all their needs related to real estate.
And then if you want to refinance your rental contract, reach out as well.
Correct. And it's on the app as well. You can actually apply online.
So anytime during the tenancy, you can cash in. How can you work with... What do you need from agents?
So we have a lot of agency partnerships. We can work with them on the property management side if they don't do any property management and share revenues that way. We can also work with them on helping them lease their inventory. So what I mean by that, they want to lease it out to tenants that are credible, that have been checked. We've already done the credit checks, and we have a lot of tenants that are coming their way that are looking for units. The agencies get to keep the full commission, and we get to make sure that the tenant is happy and they find a home for themselves, and we help them do the rent now, pay later, and to pay in 12 installments.
Okay. So essentially, does it have to be an agency that doesn't do property management?
Not at all, not at all. It could be any agency that has listings. It's just a way to help those agencies get more demand for the units that they have. And we typically will take on that task to bring them that demand and get them qualified leads.
So effectively, you're a reverse lead generation tool, because a lot of companies are spending, a lot of agencies are spending so much money. Granted, it's not on tenant lead generation, it's on buyer lead generation.
But they do on boosting ads and everything to make sure that they're serving their clients well. And that's what all of us want to do.
Yeah. So essentially, if you have a big leasing team, you've got, I'd say, in excess of 50 leasing properties on the market, you can sign up with Keyper to be essentially like a marketplace for these tenants that are...
Correct. We just basically get a feed of those available units, and we start bringing them qualified leads that they can help convert.
Okay. All right. We're going to move on now to startup world. Okay. I mean, my audience is mostly real estate professionals, but I think especially the next generation, people in real estate, it's not there's some old timers that have been in it for a long time, but most real estate professionals are doing it for 2 to 5 years and then they tap out. So maybe they're going to go into entrepreneurship. I want to get your advice for those people.
Sure, happy to help them.
And now it's kind of like everyone's a tech startup founder or wants to be, because they see kind of the millions being made from a very simple idea, but they don't understand how hard it is to actually win. Or, you know, and there is a startling statistic that only 2% of startups will not fail. So
I didn't know that before I started.
It's 98% will. And even, you know, the VCs, venture capitalists, they expect that 90% of their investments will not make it. But one of them will absolutely throw it out the park.
Yeah, no, VCs have a bit of a portfolio management, and they do assume a certain percentage of the investments that they make will not make it to the end. But no, I think they expect, I think they hope that at least 70% of the tech founders and startups they back will make it through. And you're right, the 20-30% are the stars that's going to help them
cover everything,
cover the returns and give them this extra returns for all their investors.
So I've done some digging and found 8 research-based common mistakes that tend to lead to startup failure.
Okay.
And I want you to explain and give us your opinion on how you can avoid this. So the number one is lack of... And then we're going to go through a glossary of tech terms. In fact, let's do the glossary first, because that might help in this conversation.
Sure.
All right, so there's a few words. Product market fit. What does that mean?
It means that the product that you're coming up with, there's it is solving a problem, and you're seeing adoption from the community to use the service or the product. And it's very important that you establish product market fit, and not only 3-4 people, or it's a very niche problem that you're solving that solves it beautifully for few people, but it's very, very difficult to scale.
Okay, so the answer's on the tin, really. The product fits the market on a grand scale, not just a problem you had, you know, and maybe a couple of your friends had, but that's not big enough to solve. All right, runway.
Runway
Our favorite
is
word.
what keeps me awake at night, because all startup, go through phases of funding, and they want that funding to last them until the next funding and until they spike their revenues. So you're always managing the runway, and you're trying to reduce your cost and reduce your burn. I don't know if that's
Oh, no,
another one of
we
your
didn't
words.
put that word, but you could tell us what burn is.
Burn is how much you're spending or you're losing every month
Okay.
to build the tech, to build the startup, to build the name.
So that's
to
everything,
build the rapport.
salaries, marketing,
Everything.
tech costs, subscriptions, everything.
So the runway is,
How much
the
cash
burn
you
is
have.
usually, you measure that by months.
Mm-hmm.
And the runway, you decide, well, how many months of burn can you afford until you either get to your next funding round or profitability.
Right.
Break
So
even.
in simple terms, if you have zero in your bank account and you get paid on the first of the month, and let's say your salary is 15,000, but your burn rate, which is your monthly expenses, is 15,000, then you have runway until the end of the month.
Correct.
That's a simple way of putting it. Okay. Right, MVP.
MVP is minimum viable product, and it's
Not most valuable player, not in tech terms.
correct. And it's basically the product that the entrepreneur invests in and puts together to showcase to their investors and early believers and their angel investors mainly. Say, well, this is what's going to look like. Obviously, that's not the full product, because the product, takes years and years and years to develop over time, and you keep enhancing it. But you can, at least by seeing the MVP, get a sense of where the roadmap of that.
Okay, so the minimum viable product. Explain what the rounds are. So you've got seed, you've got Series A, Series B, and the rest of the alphabet.
Yeah.
Explain the rounds.
So there is what I call pre-seed is usually the money you put. Usually you put that, the founders put that money, or they have early family and friends to get to the MVP round or to get to the seed round, which is going to start your company. The seed round is just that people who are early believers, you still, they're coming kind of a bit pre-revenue. And that seed round continues up to the Series A.
Right.
The Series A is when you set a valuation for the company, and typically you have investors, some of them a lot of times are VCs, that say, well, we like what you're doing, we see the revenues that you generated. Based on that revenues, we estimate that your value is X, $20 million, $30 million, and that becomes the Series A. And on the Series A, you raise a certain amount. And Series A is a very, very important threshold
Milestone.
because it basically crystallizes the value of what that startup is at any given time. But all those valuations are a bit more on paper than in reality, because no one can, it's very difficult for people
valuing
to
a
buy
property,
and sell at those properties. So they become very, very theoretical until there's so you do the Series A, Series B, Series C, until you get to an exit. An exit could be an IPO, and we've seen few startups in the region that I IPO'd.
What's IPO?
Initial public offering.
Okay, what does that mean?
Which means when you go from being a privately listed company to a publicly listed company, where anyone in the market can buy and sell your shares.
Right.
And the other status that we talked about was unicorn. And a unicorn is a startup that is valued at $1 billion. So that becomes another benchmark. And those are the ones that are considered successful in tech investor terms.
And how many billion-dollar exits have there been in the region?
Well, there's two different things. $1 billion exits and $1 billion are two different things.
Okay.
Because you can get to $1 billion valuation. So, for example, Kitopi has reached $1 billion valuation, and Tabi and Tamara, but there has not been any exits, right? So I estimate that in our region, there's about 10 to 15 unicorns today.
Okay. All right. Bootstrap.
Bootstrap is what we do every day as startups, because basically you have very limited resources and you have a lot to do. You have to build a full company, right? You have to spend money on marketing, you you have to have accounting systems, you have HR, you have to rent a place, you have to hire employees, you have to pay for the tech, and all of that costs money. So bootstrapping is trying to basically use the funds that you have
So
and
whether
make
it's your
them
own personal money or,
or even the investors' money, but make sure that they last with you for longer and longer until you're able to show growth with that investment.
Okay. We've got a few more. TAM. TAM.
TAM. TAM is total addressable market. And it's very, very important, especially early on for investors. I meet a lot of founders or young entrepreneurs that they have a great idea and it does solve a problem, but the problem it solves and the idea they have is small, and the potential for fees just in that market is very, very small. When I looked at creating Keyper, that was a big focus on what I'm looking for, and I saw the TAM in real estate is massive. There's billions of dollars that are made in leasing commission, in sales commissions, in property management fee, and on top of that, there's a huge opportunity on the financing side. And that attracted me to know that this is a large TAM that we're going after, and that's only in Dubai. And you can then replicate that success in other markets.
In other cities, yeah. Okay. Venture capital.
So venture capital is an institution that invests in tech companies, and they're a portfolio manager where all of the tech entrepreneurs come to them, they pitch them ideas, and from every 100 ideas that they get, they probably would explore 10, and then from the 10 that they explore, they would invest in 1 or 2. So they're very, very selective in their approach.
And it's not their money, though. Whose money is it?
So the money is typically, well, venture capitals, they have a GP-LP structure. So there's a general partner and a limited partner. And the founders themselves are typically the general partners. And they would put some of that money, or they would seed that money. And then they would go out to families and institutions and raise money for their funds.
Okay.
And these funds typically have a tenor. So they're between 5, 8, 10 years tenor, where they would invest in a startup, and then they would expect to get back that money within that life cycle.
Is it usually 10x their investment, or what do they expect?
It's not 10x. They would invest in a number of startups, and they want 10% of the startups to make 10x, which returns the money for the
everyone.
fund.
Yeah,
Exactly.
And then lastly, pivot.
Pivot is, it's a positive word, but basically all startups, they start with an idea. They want to build something. They want to address a certain problem. But as they're doing that, a lot of other problems they face, and they also try to address those problems. And sometimes the other problems that they're addressing become more important for the business. So they tend to focus on them even more versus the initial problem that they were set out to solve.
Okay. Thank you for that glossary explanation that will lead us perfectly into the top 8 reasons why they fail and your advice. So what would your advice be for a tech founder or entrepreneur on getting product market fit right?
I mean, product market fit is important, but you need to speak to a lot of people, and you need to understand the market, you need to understand the problem, and you need to understand the margins. So you could be basically solving a problem, but as you're solving that problem, there's so much competition that the margins are very, very small.
Yeah.
So yes, you're solving a problem, but the others are doing the same, and the margins are very small. So my advice is to look for large problems, look for problems that are not just unique to your market, but also exist in other places in the market, because that becomes growth opportunities, and look at opportunities that have larger margins that you're addressing.
And would you avoid a niche that had too much competition, or would you?
Yeah, I mean, absolutely. That's true in any business. that you work on. You may have your niche in solving that problem, and or your way in doing that, or your way you're marketing yourself, or you're going out to the market with it. But yes, if something is very, very crowded, or if an industry is dominated by very large unicorns, it's going to become more and more difficult to compete with these large entities.
Yeah, I saw this poor guy. There was something on Instagram the other day. He was like, so my startup's just gone out of business because Google has released the same product that he had been working on for years and years and years. And like just like that, Google comes along.
So this happens all the time. That's why it's not enough to just have a good idea. Because if you have a good idea and someone say, oh, that's a great idea, and they have like unlimited unlimited amount of investment, they can just go after the problem and do it bigger and better than you would, and take you out of business.
Okay.
The nice thing about startups is they tend to be faster than the
Googles.
Exactly, the Googles of the world. Okay. So Google, for example, if you've built enough scale, so they'll say, well, you know what, I prefer to buy you, and that becomes a great way for you to exit, buy you out and take what you've built and then scale it to the next level.
Okay. And then the number 2 reasons why most startups fail is running out of runway. So what's your advice there?
So my advice is, like I'm a banker and then 18 years of banking before being an entrepreneur, and still difficult. So you need to be fundraising every day, and twice over the weekend as well. And even if today, for example, we just finished the fundraising, I'm already fundraising, and I was meeting investors yesterday. I'm talking about our next round.
Right.
Even for people that do not come to your round, it's very important to stay in touch. And to share with them the successes, because even if they don't come in the first time, the second time, the third time around, they'll become a believer, and they'll build more comfort and more familiarity with what you're doing.
Okay, so always be raising. ABR. No clear business model is another reason why startups fail. 17% of startups fail due to a lack of a clear business model. What would your advice be there?
Yeah, look, I mean, business model is the first thing you need to put together. And a lot of startup, or back in the day, they would have these startups and they'd be growing revenues, but when you looked at the actual business, yes, they're growing revenues, but actually their cost is higher than the revenues, and it's very difficult to go back and make it profitable. So you need to have a business plan, and I would say, if possible, have a diversified business plan. So don't rely on one revenue source. If your business plan allows you to rely on 2 or 3 business sources, it helps you hedge your bets, and it helps you, if something picks up, the other ones. For example, a portion of what Keyper does is revenue from sales and off-plan sales. That market is very, very hot right now, and it's really helping us. But in the future, if that market slows down significantly, then we have other revenue sources to rely on as well.
Right, number 4, not figuring out marketing and sales. So 14% of startups fail due to poor marketing. I mean, this was one of our biggest challenges.
Yeah, absolutely. I mean, it's still a big challenge for, I would say, most startups. There is unlimited number of marketing agencies and ways to market your products, and
what about all that touchy-feely stuff, like
and influencers and SEO, and there's so many ways to do that and bring in traffic, and it can cost a lot of money. It could take a lot of the burn. Some of it is successful, some of it is not. So I would say you have to try different things, and you have to make small investments and see what works best for you, and then double down on that.
One thing that you used to, we used to both get frustrated about, was all this like touchy-feely stuff that the marketing agencies would make you do, like, oh, the awareness side of things, or oh, let's, the brand look and feel, all of that stuff. What's your advice on?
I mean, look, your brand look and feel is very, very important, but just you have to be focused on what's important. What's important marketing has to be driving revenues and has to be driving sales. If marketing is not succeeding in doing that, then you're doing something
not working.
wrong.
Yeah, you might look great or whatever and have like amazing reach on your social media, but if it's not converting, it's not working. And I actually find that it's, as a founder, it's very hard for you to explain to a marketeer what your vision is, what your purpose is, what you're trying to achieve.
So this is why you need to find someone who's in marketing. A lot of companies do the marketing in-house as well, because it's very, very important that they fully understand
the business.
If someone's not understanding the business, then they're not going to be able to help you market this.
Okay. Well, that leads us on perfectly to the fifth reason, and a reason why 25% of startups fail because they lack the right team. So how do you prioritize putting a talented team together?
That's the top priority. I mean, at the end, you may have the best product, the best idea. If you don't have the right team to execute and the right culture built in, then you're not going anywhere.
Okay. We're on our last three, not adapting to change. So this is my favorite one. And a study found by Harvard Business School found that 75% of venture-backed startups undergo at least one major pivot during their journey. Would you call rent now, pay later a pivot?
Yeah, I mean, it is.
We had the idea early on.
We had you know that. We had it from day one, that it's a problem that we've identified, we wanted to solve it. But when we tried it out on a limited scale, the responses were insane. The market was telling us, we want you to focus on it. The investors we were talking to were encouraging us to focus on it as well. So we did, divert a lot of the resources to basically scaling up rent now, pay later.
How do you, what's your advice to founders when to pivot? What's your take on that?
I mean, there's no perfect time. It's something that you have to basically be wired to do at any given time.
Right.
You need to be very, very flexible. You need to find opportunities. You need to, let your business model adapt and sometimes pivot and sometimes shut down. And there's, I found this, a lot of people go with an idea that this is what we're going to do and that's going to generate a lot of money for us. But when this doesn't work, they keep at it until they run the company to the ground. It's very, very important to say, well, you know what, we've tried it.
Didn't work.
It either didn't work or it worked, but it's just very, very slow to grow and to scale. Because the startups go through what we call value of death. And value of death because you have that limited runway to show the growth. So if you don't show that growth within that limited time of runway, the next investors are not going to give you the money.
Right.
So even if it's showing that, yes, there's some people adopting, but it's not growing fast enough, then that may kill the startup.
Okay. Lack of focus is a reason why 13% of startups fail. They're trying to do too much at once.
Yeah, I mean, look, we come up in every industry, in every startup, a lot of other problems get thrown at them. And there's that skill set of you can't do everything. And if you want to try to do everything, you're going to fail at everything. So you need to become an expert matter and, where people go to you for certain things. But you don't want to keep it very niche where they're only coming to you for these things. So you do, it's a balance that you strike between not losing your focus and kind of focusing on 2 or 3 business lines that will generate 90% of your revenues.
So your advice is always have something kind of under the radar that you could pivot to, additional revenue streams.
You should always be exploring everything and then deciding what are the 2 or 3 businesses that you're focusing or the features that you're focusing on.
Okay. And lastly, mismanagement of growth. So scaling too quickly or struggling to manage growth is a reason why 70% of startups fail due to premature scaling. What do you think the strategy should be there?
I mean, again, it's striking balances. You need to have your pulse on the market. You need to spend your marketing dollars wisely or dirhams and and try different venues to figure out the scaling and the revenue growth.
Okay. So we will wrap this up with your advice. Well, because everyone is going to be watching thinking, it's not just 34 million you raised, it's plus the 6 from before. So what, if someone's watching this, how do you go about raising $40 million plus? The stage is yours.
Yeah, I mean, it's not easy. I'll be the first to admit it. Look, again, you need to be speaking to investors on a daily basis. You need to network. You need to meet more and more investors. Ask your investors to introduce you to other investors as well.
Where do you start looking for investors? Where does it begin?
So it has to begin with your immediate network.
Right.
PR also helps. Being out there on podcasts like this one and in the news and everything really helps the startup founders get there
noticed.
and get noticed. And then people will come and approach you to better understand, be intrigued. So you always want to be intriguing people with what you're doing.
Right.
You want to build something that's innovative. If you say, well, I'm just going to do another copycat of another company, like, okay, we've seen it, done that, why would yours work? It's difficult. And then you need to be convincing, you need to share the business plan, you need to share the time, you need to be able to present to venture capitalists. And if you have a VC on your cap table as one of your investors, that helps a lot, because that also gives you credibility as a founder. And you know that there's an institution that has done deep due diligence on your company, on your legal, on your financials, on your tech capabilities to ensure that everything's proper.
So it's kind of like they've already credit checked you.
Correct.
And you must
They give you like a stamp.
It's
like
a stamp of approval, seal of approval. And you must have seen like some horrendous decks, pitch decks in your time. Like what's the main top 2 bits of advice to founders on their pitch deck? Again,
I mean, I see the 8 problems that you've identified. Your pitch deck should be able to address those.
Okay.
You need to be able to convince people of the problem, of the TAM, of how you're going to go about it, and the margins, and the roadmap of how you're going to get there, and who you are and why the founding team or your team is the right team to take this forward, and then the threats from outside, how defendable is your business model.
Brilliant. Thank you very much for joining me, Omar. And you're welcome. Don't forget to like, share, and subscribe.